Welcome to the deep dive. Today, we're looking at something really interesting with Analog Devices, Inc., ADI. They just dropped their Q2 2025 results, and, well, on paper, it looks fantastic. We've got the earnings reports, the press release, the earnings call transcript, which has all the details, and some analyst reactions, too.
Right.
So our job today really is to sift through all this, get past the financial speak and figure out what's actually going on with ADI now and maybe what's next for them. We're trying to get the whole picture.
Exactly. We're piecing it together. You've got the company's numbers, what their own leadership is saying about those numbers, and then, crucially, how outside analysts are interpreting it all.
Yeah.
Putting those views together should give you, the listener, a much clearer sense of things.
Okay, so let's get right into this kind of puzzle. ADI had a great Q2, it seems. Revenue was $2.64 billion. That's a 22% jump from last year.
Pretty significant jump.
Yeah. And they easily beat what analysts were expecting, which was more like $2.51 billion. And it wasn't just revenue or their adjusted earnings per share, $1.85. Again, higher than the $1.70 consensus.
Right.
Their CEO, Vincent Roche, he talked about an ongoing cyclical recovery and how their business model is holding up even with all the global trade volatility. So, good news, right? But the stock price didn't exactly jump for joy.
Well, and it's interesting, the CFO, Richard Puccio, he was saying similar things, mentioned improving demand signals, talked about a cyclical upturn. So the leadership message was pretty consistent and positive.
Good, right?
Which, as you said, makes that stock reaction a bit more intriguing.
Absolutely. And this growth, it wasn't just one area carrying the load. They saw double-digit growth year over year in all their main markets. Industrial hit $1.16 billion, up 17%. Strong showings in aerospace, defense, and AE, that's the automated test gear.
Yeah, ATE is key for chip manufacturing.
Then automotive, wow, a record $850 million for them, up 24%. They said it was driven by connectivity stuff and safety power systems, especially big in China.
The China EV market is huge for that kind of tech.
Right. But they also saw growth sequentially, quarter over quarter, in Europe and North America, too. So pretty broad strength there.
That sequential growth is important, suggests it wasn't just a one-off regional thing.
Then communications, up 32%, $315 million. Mostly wireline and data center stuff. Apparently the AI build-out is boosting demand for power and optical components.
Makes sense. AI needs a ton of power and high-speed connections.
Yeah. Wireless actually grew from Q1, though it was down compared to last year. And even consumer electronics, $318 million, up 30%. That's their third quarter in a row of strong growth there. They think they're gaining share and getting more of their tech designed into devices.
So across the board then, industrial, auto, comms, consumer, all growing double digits year over year. That's pretty robust diversification.
It really is. Shows they aren't just reliant on one thing. Okay, so revenue looks good. What about making money on that revenue? Margins.
Yeah, good question. So their adjusted gross margin was 69.4%. GAAP was lower, 61%, but that adjusted number is pretty high.
And it was up from the previous quarter?
It was, yeah. They said it was because their factories were running at higher capacity, higher utilization.
Okay. And operating income?
Also strong. Adjusted operating margin was 41.2%. The GAAP number was lower, 25.7%, but still up a huge 76% year over year. So that revenue growth is definitely flowing through to profit.
Good to see. And cash. Are they generating cash?
Oh, yeah. Lots of it. $819 million in operating cash flow just in Q2. Free cash flow was $729 million.
Wow.
And if you look at the last 12 months, it's like $3.9 billion, operating $3.3 billion free cash flow. That's 39% and 34% of the revenue over that period.
Very healthy.
Yeah, they're sitting on it? Or
Nope, returning a good chunk to shareholders. About $700 million in Q2 through dividends and buybacks. They just declared another dividend, too, $2.99 share, payable mid-June. Okay, so strong Q2, good profitability, lots of cash, returning cash. Sounds pretty solid. What about the outlook? What are they guiding for next quarter, Q3?
They're expecting revenue to be around $2.75 billion, give or take $100 million. So sequential growth from Q2.
Right.
Adjusted operating margin expected around 41.5%, similar to Q2, even with, they mentioned annual salary increases kicking in.
Okay. And earnings per share.
Adjusted EPS guidance is $1.92 plus or minus 10 cents. Again, looking pretty solid sequentially.
And which areas do they expect to lead that growth?
They're pointing to industrial and consumer to lead the sequential growth. Communications also expected to be up. But interestingly, they expect automotive to decline a bit from Q2's record level.
Ah, okay. So maybe that record Q2 in auto wasn't entirely sustainable for Q3.
That seems to be the implication. And actually, digging into the earnings call gives us some clues there.
Oh, yeah. What did they say?
Well, they talked about the impact of tariffs. And specifically in automotive, they saw what they called choppier than normal buying,
Choppier.
meaning some customers, likely worried about upcoming tariffs, pull their orders forward into Q2.
Ah, a pull-in.
Exactly. They estimated it boosted Q2 auto revenue by a high single-digit percentage. So some of that Q2 strength was borrowed from Q3, essentially.
Got it. That explains the expected dip in Q3 then. Makes sense.
Yeah, they expect things to normalize now. It's a really important bit of context for those numbers.
Definitely. Did they sound worried about the overall economy, though? Or just this tariff noise?
They seem pretty confident about a cyclical upturn. They mentioned that inventories out in the distribution channel are lean.
Which is generally a good sign, right?
Right.
Means demand is real.
Right. They expect to be shipping pretty much directly to meet end demand, especially in industrial in Q3. And speaking of industrial, their book-to-bill ratio.
Orders versus shipments.
Exactly. It was above 1 across all their industrial subsectors. So demand still looks strong there, even with, some customer hesitation they noted because of the tariff uncertainty. But the need for automation seems strong.
Automation. And they talked about robotics too, didn't they?
They did. Sounded quite excited about it, actually. Not just factory robots, but moving towards autonomous, mobile, even humanoid robots eventually.
And ADI sees a bigger role for their tech in those.
A much bigger role, potentially. Think about all the sensing, the edge computing needed, connectivity, managing power. ADI plays in all those areas. They see a lot more content per robot in the future.
Interesting. Are they investing to capture that?
Seems so. They highlighted R&D spending and also investments in manufacturing capacity, expanding in the U.S., Europe, and working with TSMC in Japan on advanced chips, giving customers more supply options.
Okay. Anything else to about from the call?
Yeah, there was an interesting point on their operating leverage.
How so?
Well, part of their employee compensation is tied to year-over-year growth in operating margin. Because 2024's margin was lower, this variable pay is actually growing significantly in 2025 as margins recover.
Ah, so the cost is growing alongside the margin improvement.
Exactly. It's kind of muting the percentage margin expansion this year. But they expect more leverage, more profit drop through in 2026 if the recovery continues and that comparison base is higher.
Right, that makes sense. Investing in the team, but it affects the near-term margin percentage.
Okay, let's pivot to the analysts. What are they saying? We know the stock dipped, but what's the view?
It's a bit mixed, actually. Guru Focus, which uses a quantitative model, their GF value, suggests the stock might actually be significantly overvalued right now, like nearly 20% potential downside based on their calculation.
Okay, that's one view. What about Wall Street analysts?
Their average one-year price target is around $240.75, which from the current price implies some upside, maybe around 8% or so.
So a more positive outlook there.
Yeah, and the overall consensus rating from analysts is outperform, so generally leaning more positive than that GF value metric.
Okay, so we have this quantitative model saying overvalued, and analysts mostly saying outperform with some upside potential. It often happens. The quantitative models are usually backward-looking or based on intrinsic value calcs, while analysts factor in future projections, sentiment, maybe catalysts, different approaches.
Which brings us right back to that stock price drop, down almost 4% despite beating earnings and guiding positively. What do we think happened? Was it the Guru Focus valuation concern?
Could be part of it. Maybe the market agrees it's a bit richly valued. Or perhaps, like we discussed, the guidance, while good, wasn't a huge blowout compared to what was already baked in.
Or maybe that automotive pull-in and the expected Q3 dip spooked people a little.
That's possible too. Concerns about the sustainability of that growth, especially in a key market like auto. Or, sometimes it's just broader market conditions on the day. Hard to pin it on one single thing.
But it's a great example for you, the listener, right? Strong results don't always mean the stock instantly goes up. The market's complex.
Absolutely. Perception, valuation, future worries. They all play a role.
One last quick point, inventory. Did they mention that?
They did. It went up slightly sequentially, about $50 million, which they said was to support the expected recovery. But their days of inventory actually decreased a bit, down to 169 days.
So holding a bit more themselves, but turning it over faster?
Seems like it. They want lean inventory out in the channel with their distributors, but enough on hand themselves to meet demand. It's a balancing act.
Okay, so let's wrap this up. ADI posts a really strong Q2, beats expectations, grows across the board, gives a decent Q3 outlook, sounds confident about recovery.
Yep, fundamentals look pretty solid. Good margins, strong cash flow.
But potential issues like tariff impacts causing pull-ins, valuation concerns flagged by some, and maybe the guidance wasn't quite explosive enough for the market, and the stock price dips.
And that, I think, is the key insight here. The gap that can exist between a company reporting good results and how the market actually reacts in the short term. It forces you to look deeper.
Exactly. So the question for you, the learner, is how do you weigh these things? You've got the long-term potential drivers for ADI, AI, automation, healthcare tech, all these big trends. Then you have the short-term market noise, the valuation debates, the tariff worries. What does that difference tell you about fundamentals versus stock price? And thinking about ADI specifically, what other questions does this raise for you? What else would you want to dig into to really form your own opinion?
Some food for thought there.
Definitely. That's our deep dive for today. Thanks for joining us.